Well, good morning, Joginder Rana here. The topic of the day is political risk insurance. Political risk insurance. The Indian financial market witnessed exciting twists and turns throughout 2024 due to events from all fronts: political, economical, social, and corporate, both global and domestic. Indian market started the year with high hopes, then saw really miserable levels in middle of the year. So in India, these political upheavals are always there. This There is a definite growing global presence of India in the international market that brings the danger of a greater exposure to political risk by the Indian companies working abroad. Precisely that aspect prompted me to come forward to start a discussion on this topic. What is political risk, in fact? Basically, the political risks are the inherent intangible risks being faced by the firms who are doing business internationally, arising from the actions or inactions of the insured government or a foreign government or government entity or a third party country which deprive a company of all or part of its assets or prevent or restrict the performance of any contract. So war, riots, coups, embargoes, the sort of political upheavals that once occupied statements, mercenaries and spies. These days also the concern of the less swashbuckling figure in the world of finance. So a brand of corporate risk officers, export managers and international bankers are looking to insurers to shield them from the financial consequences of political turmoil around the world. The political risk cover would once have appealed only to the most intrepid enterprises, oil firms prospecting in the Niagara Delta or mining operations in dodgy corners of Central Asia. So there is, but as companies push their business into ever more remote localities, so they have sought protection against more toxic risks. The dangers of political now hang over companies as diverse as fruit growers in Latin America, film producers in Fiji, and bankers in Dubai, London, or New York. So, what is political risk insurance? Political risk insurance is a tool for the multinational companies or enterprises, equity investors, and financiers, contractors, importers, and exporters to mitigate and manage risk arising from the adverse government actions, confiscations of assets, breach of contract or war, and civil strife. The PRI helps as a risk mitigation tool to provide a more stable environment for the various investments into developing countries and to unlock better access to finance. The multinational enterprises, either as direct investors or exporters, use the PRI to enhance their confidence in the market perceived to be riskier than home markets. PRIs allows investors to concentrate on the commercial aspects of investment with the comfort that someone else PRI providers will help them avoid potential losses or reimburse them in case of covered loss related to political causes. The political risk insurance is a type of insurance that can be taken out by the businesses of any size against political turmoil, the risk that war, invasion, act of foreign enemy, hostilities or warlike operations, whether war be declared or not, civil war, mutiny, civil commotions, assuming the proportions of or announcing to a popular rising, military rising, devolution, revolution, insurrections or military or usurped power, or other political conditions that will result in a loss. Political risk insurance is available covering several types of political risks, including political violence such as revolution, insurrection, civil unrest, terrorism, or war. Governmental expropriation or confiscation of assets, governmental frustration or repudiation of contracts, wrongful calling of letters to credit or similar on-demand guarantees, and inconvertibility of foreign currency or the inability to repatriate funds. So, as with any insurance, the precise scope of coverage is governed by the terms of the insurance policy. Big and multinational companies are drawn to expand into international markets, mainly in search of lower cost, considering the new opportunities and easier access to potential resources. When they arrive, however, they often find that the policies of foreign involvement adds a risk and complexity to their business performance. A question for companies operating internationally thus becomes how best to manage the political risk. Not only do political changes pose direct risk to firms, organizations, but politics is also a component of other external risks. Moreover, political risk is often perceived to be outside of management control, making it difficult to define or predict. So, given to the complexity of these issues, it is no wonder that corporate risk officers, export managers, and international bankers will be looking for this cover, simply because the political risk insurance protects an insured in case of foreign country confiscates its goods or equipment, or if it interferes with the fulfillment of a contract to be complied by the organizations. Nowadays, the political risk insurance cover becomes the dire need to be covered by the MNCs or the companies who are engaged abroad, mainly because the politics of foreign involvement adds risk and complexity to business performance. PRI helps provide a more stable environment for investments into developing countries. India's PRI market is still minuscule by global standards, but India's investment in developing countries like Southeast Asia, Africa, etc. will drive definite growth in PRI in future. So, the underwriting of political risk insurance is a dynamic and growing business. As globalization increases, there are more corporations doing more business in various places around the world. With each passing year, some of the changes occurring as a business are high growth, new product offering, and a greater role of the private capital. So, while political risk insurance policies are sometimes manuscripted for specific situations, the major political risk insurers have standard forms for the coverage that they have. So, political risk insurance is available for political violence such as revolutions, insurrections, civil unrest, terrorism or war, government expropriation or confiscation of assets, government frustration or repudiation of contracts, wrongful calling of demands, guarantees, and inconvertibility of foreign currency or the inability to repatriate funds. So, Export Credit Guarantee Corporation in India had virtual monopoly to issue political risk insurance cover for credit risk. Things have potentially changed after insurance sector liberalization. Companies are drawn to expand into international markets, in search of lower costs, new opportunities, and access to resources. When they arrive, however, they often find that the policies of foreign environments add risk and complexity to their business performance. The question for all such companies operating internationally thus becomes how best to manage political risk. Not only political changes pose direct risk to such firms, but politics is also a component of other external risk. Moreover, political risk is often perceived to be outside of management control, making it difficult to define or predict. So, north based industries in the global market are in the opinion that the southern hemisphere is not conducive for investment. The reason is the involvement of risks such as localized small intensity conflicts, political violence such as civil unrest, revolution, uprising, terrorism, insurgency, and sectarian violence, which are mushrooming mostly in Asia, Africa, and Latin America. This fragile, unstable governance situation creates hurdle in the process of business, as usual for the mandarin's of market economy and globalization. So, to avoid the loss of investment, the private companies seek precautionary approaches in terms of commercial and political risk insurance and export credit guarantee. Political risk insurance policy. The forced exit of GMR infrastructure from Maldives earlier has caused a huge loss to the Indian company, but GMR, which has claimed a compensation of $800 million from the Maldives government, could have easily cut its losses had it purchased a political risk cover. So it is an insurance policy brought by companies to cover losses arising out of the adverse political developments in foreign countries where they have their projects or businesses. Such policies cover losses caused by political violence such as revolution, civil unrest, terrorism or war, confiscation of assets by government abroad, wrongful calling of letters of credit, and business interruption. Such policies have a standard risk coverage format, though they can be modified to suit the requirement of the client. So, a decision to buy such covers depends upon a company's own assessment of risk, its concerns about political risk associated with its specific investments abroad. Sometimes banks drive the purchase of political risk covers. Many banks do not lend to project without this insurance, either because of their own internal risk management concerns or because they have reached their lending limits for a given country. So, Export Credit Guarantee Corporation, a government enterprise, provide the insurance in India. Any company investing outside India can buy a risk cover from ECGC or the Multilateral Investment Guarantee Agency, a member of World Bank Group. ECGC bears 85% of the loss, which is part of a comprehensive cover. ECGC, however, cannot provide cover to overseas companies investing in India, as it cannot cover sovereign risk, which is generally bought through a broker. So the premium varies from country to country. Underwriting of political risk insurance is a dynamic process and it depends on the situation in that particular country. So the size of a political risk insurance policy is generally equal to the investment made by the company abroad. The political risk insurance protects the contract against the risk of non-payment of buyers, unfair calling of on-demand bid or contract bonds, honoring of letters of credit, import or export restrictions, non-delivery of pre and paid goods, war, civil strife, revolution, insurrection, military, usurped power or destruction by or under the order of the insured government, currency inconvertibility, contract repudiation by buyers. So one of the most vaunted aspects of such TT right is that arbitration are administered via the International Center for Settlement of Investment Disputes. Political risk insurance provides cover to an insured for the risks such as exploitation of foreign state or currency risk. Thank you very much.